Welcome back. Our last AJE that we're going to talk about is depreciation. So depreciation is the expense of a long-term asset or a capital asset. So oftentimes in business, we have to buy some sort of an asset to use in our business. Maybe it's equipment, maybe it's a vehicle, maybe it's a building, some sort of machinery. And we're going to use that over an extended period of time to support our operations, to help us generate revenue. Now, if we remember back to the matching principle says that we need to match expenses to the revenue that they're used to generate, which means if we're going to use, in this case, a vehicle for 4 years, we need to expense that vehicle over the 4 years. So each period, a portion of the cost of the vehicle will be booked to expense to match the revenue that it helps to generate. Okay, so in our example, we have Truckee Inc., and they buy a vehicle for $50,000. The vehicle has an expected useful life of 4 years. This is an estimate. Management is often called upon to estimate, and at the time we bought the vehicle, we think we can use it to generate revenue for 4 years. It may end up being 3.5 years, it may be 5 years, but our best estimate's 4 years, so that's what we're going to use in the calculation. Also, we estimate that we can sell the vehicle for $2,000 at the end of the useful life. This is called a salvage value. The salvage value is what we think the asset will be worth when we are done using it to generate revenue. Okay, so what is Truckee's monthly depreciation expense? The formula for that is cost minus salvage value divided by the useful life. Okay, write that down, have it in your notes. Again, this is something you don't necessarily need to memorize it, just have it handy. So if I ask you to calculate depreciation either in the homework or on a quiz or exam, you've got it handy. All right, so let's do that calculation. So our cost is $50,000. That's what we paid for it. And minus our salvage value is 2,000 divided by our useful life. Our useful life is going to be 48 months. We're calculating monthly depreciation. We estimate the vehicle will be good for 4 years, times 12 months per year is 48 months. Right, so our monthly depreciation expense is going to be $1,000. All right, so first let's do our journal entry to record the purchase. And that is going to be, oh my goodness gracious, I'm a terrible typist today. Okay, so we did this when we bought equipment back in module 3, but we're going to debit vehicle, and we're going to debit that for 50,000, and then we're going to credit cash or AP, whatever it is, 50,000. Okay, just gonna do some quick formatting here so that our numbers look like numbers. Okay, so then when we go to record monthly depreciation expense, we are going to debit depreciation expense because we're increasing an expense. Expenses have a natural debit balance, so to increase an expense, we would debit it. So we're going to debit depreciation expense, and we're going to debit that $1,000. We'll do this every month for 48 months. Okay. Our credit, you would think it was going to be to equipment because we're basically reducing the value of the equipment on our books, but we're not. We're going to use something called a Contra asset account. A Contra asset account sits with the assets, but it has a natural credit balance. Okay, and our contra asset account is called accumulated depreciation. And we're going to credit for that for 1,000. Okay. So if we wanted to know what is the value of our vehicle, we would take the amount that's sitting in the vehicle T account, excuse me, 50,000, and divide and subtract our accumulated depreciation, which in this case is 1,000. So the value of our truck, our vehicle, is 49,000. Next month, when we book this exact same journal entry again, there will be a total of $2,000 in our accumulated depreciation account. And so the value of the truck will be 50,000 minus 2,000, or 48,000. Okay, so when we're booking depreciation, we never impact the original asset account. We instead impact the contra asset account of accumulated depreciation. And when we get to our trial balance and our T accounts, and even our financial statements, that contra asset account is going to sit with the assets, even though it has a natural credit balance. That's why it's called a contra asset. It goes against the assets, so it has the opposite natural balance. All right, that is it for depreciation. And I've got some exercises you can follow up with, and let me know if you have any questions. All right, thanks.